I request our head of the department and vice principal of CPA College, Dr. S. Balamurugan sir, to welcome the gathering.
So good morning to one and all. Respected the principal and the respected today resource person, Mr. Ganesh, and the organization secretary, Mr. Tangadurai, and organization co-secretary, Mr. Madan Kumar, and the senior faculty member, Dr. Sujata, and the members of the Commerce Department, and the learned professors from various colleges, and our former head of the department, Dr. R. Jayabalan sir, and my dear the student friends, good morning to one and all. So today, in our Commerce Department conducting the 6th webinar, I think it's one among the milestone of Commerce Department for conducting the international webinar. First of all, I'm warm welcome to our Dr. Principal. Today the functions, even though he busy scheduled, even though he is attending the function, welcome sir. Then I warm welcome to the today resource person, so Mr. Ganesh. He is my very good friend and my mentor and my advisors, the Ganesh. So we are doing MPhil in Karaikudi Alagappa University, so for the period of 91-92. So on behalf of the Commerce Department, I warm welcome to Mr. Ganesh. Then I warm welcome to the organization secretary, Tangathurai, and Mr. Madan Kumar. And also warm welcome to senior faculty member, Sujata. And warm welcome to our Commerce Department, the staff members. And welcome to my friends, the professors, the auditors, industrialists, and the participants. Warm welcome to all. The last but not least, I am warm welcome to our former head of the department, Dr. R. Jayabalan sir. Thank you. Thank you for giving me the opportunity. Once again, thanks to all.
Now, I request the organizing secretary, the Professor G. Tangathurai sir, to introduce the chief guest.
Good morning to you all. Can you hear me? Honorable Principal, Head of the Department, respected Chief Guest, faculty members, and participants from other colleges, a very good morning to you all. And regarding our today's Chief Guest, Ganesh Gomu, currently he is working in UAE as a trainer in CAMA in Jabil Institute. Regarding his education, he has completed his UG, PG, and MPhil program from Karaikudi Alagappa University, and he has also completed his FCMA from Cost and Works Accountants of India, and CMA from Institute of Management Accountants, USA. He is also having one advanced diploma in management accounting from CIA, UK. And he has completed a MBA from Indira Gandhi National Open University in New Delhi, and the DHRM from Indira Gandhi National Open University. And he is also passed eligibility test for lecturership from India, and at present he is pursuing. He shaped himself into a giant by his continuous learning and expertising his knowledge in other fields. From his professional experience, he is having possession 25 years of industrial and corporate leadership in various industries, FMCG and other construction and other other industries. He is possessing 2 years BBA teaching experience in India, and 5 years of professional trainer in various industries and education institutions. And regarding simultaneously, he has also undergoing training to develop himself. He has completed CPA course training in Emerge Management Training Center and completed several IFRS refresher training programs from top audit firms, completed leadership development executive program from American University of Sharjah. And regarding his skills, he is having skills in various human resource managements like team building, interpersonal skills, out of box thinker, and problem solver. He is highly motivative, he is highly educated, who is still a learner, who develops himself and also develops others. So it is our privilege to have him as a chief guest, and a warm welcome to him. Thank you all.
Thank you, Mr. Thangathurai.
Thank you,
Now I
sir.
request to our chief guest, so Mr. Ganesh, to share the knowledge to the participants. The forum will be handed over to Mr. Ganesh. Thank you.
Yeah. Good morning to all of you, and thanks for all the kind words. See, I also would like to add to what Thangathurai was saying, that I am a grandson of Maramil Edigal. You may be aware of Mr. Maramil Edigal, Tamil poet. And
thanks, sir. It is good to see you from it. Golden words. Thank you, sir.
Yeah, and I have started my career with Unilever in India. Initially, I was a professor, and then later I joined in a Unilever company in Bombay, and then my journey continued with corporate and industrial areas till date, and I'm still working as a corporate professional. I'm a senior finance manager, and so today's topic is revenue recognition model. It is a very interesting topic, but it is a very dry topic, which I will try to make it more interesting during the discussion. So I will be basically, what I'm going to cover is I'll be covering background, like why this standard has come, IFRS 15, and what are all the core principles, and what are all the areas of impact, and what are all the revenue recognition model which is working under IFRS 15, and which are all industries are impacted, and the practical examples which are related to the concepts, and finally, if you have any questions, then we can discuss. So moving on to the background, why this standard was introduced, like IFRS 15 was introduced, because there were many standards in 2018. So this standard came in 2018, January. And I was in fact part of the project champion in my company, where we were driving the implementation of IFRS 15. So as you are all aware, sales or revenue or turnover, which are interchangeably used, is constituting a company's key financial information, right? Presenting its financial results or financial standing, and also its future prospects. So that means revenue is having said revenue is a accounting judgment or accounting estimate. So people can play with revenue as a number, right? If you look at, in people in general, people would say, if you look at a P&L, profit and loss account, revenue is a sanity, profit is a vanity, and cash is a reality, right? If you have a revenue which is a top line, and the bottom line is your profit, so there is a huge gap between your revenue and profit. So that is why we are saying profit is a vanity. The profit is again depending on how the accounting judgments or estimates you are making in arriving at the revenues or booking your cost. So it is indeed a key performance indicator for the management as well as the owners, as well as the potential investors. Why it is key performance indicator for a potential investor? He looks at only two things, right? When he invests in a company, he looks for appreciation in his share price, or the earnings per share, like the dividend, what dividend he is going to get from the investment. So that means, having said that, revenue is very, very important. And despite their importance and the increasing globalization of financial markets, the existing accounting regulations, like previously, the revenues were being accounted based on different accounting standards, which we will be seeing in the next slide. So the accounting regulations have differed considerably, which has caused inconsistencies and difficulties in comparing the entities who prepared the financial statements in accordance with the accounting standards or financial reporting standards. And you are all aware, financial reporting standards are a common language across the world, right? When the International Financial Reporting Standard came, it started mandating all the countries to converge into International Financial Reporting Standard. Because initially, every country has its own generally accepted accounting principles. Like in India, we have Indian accounting standard. In UK, they have UK GAAP. In US, they have US GAAP. So the accounting, like the reporting regulations, where like IFRS or IAS were criticized for being overly general as well as lacking guidance on important problematic issues. So which again causes difficulties when applying them. And also US GAAP. US GAAP is a US generally accepted accounting principles. On the other hand, were broad and approaching the issues in a fragmented manner. So the neither standard was adjusted to the new reality. And one of the basic reason for bringing this standard is there were a lot of inconsistencies in construction accounting, construction related accounting or construction industry accounting. So every standard has, like IFRS standard has its own relevance. For example, recently, even in the same year, there were one more standard came, that is IFRS 9. That standard came just to plug the loopholes in, banks were showing heavy non-performing assets. So to plug the loophole, that standard was brought. And in the last year, I mean in 2019 or 20, IFRS 16 came, because the aircrafts were leased heavily, but it was neither appearing in a landlord's book or lessee's, whoever is leasing it in their book also, it was not appearing. So then the IFRS 16 was mandating that the assets have to be shown by whoever is leasing, which is based on a long-term concept. So this is what the background about why this standard was introduced. And if you see the so who are all impacted? The new revenue recognition standard, it is of particular interest to the companies who are adopting it. And American Financial Accounting Standards Board as well as the International Accounting Standards Board have collaborated together and developed this IFRS 15 standard, and which is very identical. The outcome is very identical. And the biggest changes are noticed in the entities which are offering products and services in multiple item packages, or selling licenses, or providing services in the form of contracts, and those who apply variable pricing or conditional remuneration in their contracts with clients. And industries that are mostly affected are telecom, technology. So we will see what is the intensity of impact. I have tabulated in one of the slides. Telecom, technology, energy, media and entertainment, construction, IT, automotive, real estate, and pharma and healthcare. And what has changed? Actually, what has happened is this standard, when it was implemented in 2018, it has replaced or eliminated the previous reporting regulations. So what I mean here is IAS 18, which was predominantly dealing with reporting, recognizing the revenues. IAS, the International Accounting Standard, then IAS 11, construction contract. So these are all now superseded by IFRS 15. And SIC 31, that is revenue barter transaction. SIC is the Standard Interpretation Committee, and IFRIC is International Financial Reporting Interpretation Committee. And these all, like 13, 15, and 18, those are all replaced with IFRS 15. So that means from 18 onwards, any company who adopts this standard, and it is also mandatory for every organization who are audited by Big Four audit firm, they'll always look for the application of IFRS 15 to to audit and certify their financial statements. So if you look at so continuing with so now the core principle. So why this standard was, so the objective of this standard is they are basically defining the principles that an entity shall apply to report useful information to the users of financial statement. So who are all the users, right? The users are investors, predominantly the users, investors, bankers, auditors, and employees, as well as like customers or the vendors. So about the nature, timing, and uncertainty of revenue and cash flows arising from a contract with a customer. So here, what is more important you have to understand is there should be a contract, well-defined contract. Contract is an agreement between two parties with a customer. So if we see in brief, in IAS 18, like International Accounting Standard 18, the timing of revenue recognition from the sale of goods or service is primarily based on the transfer of risk and rewards to the whoever is receiving the goods or services. But in IFRS 15, the emphasis is more on the control. So when the control is getting transferred, that time the revenue is getting recognized. So which we will be seeing in the 5-step model. So which are all the areas which got impacted with IFRS 15? So I'm going to highlight some of the points here. See here, what they are emphasizing is the revenue recognized over time. So that means, see, suppose if you have a contract with a customer which is spreading over 3 years or 5 years, then it is during the period of contract duration, or at the point of time, that is when you are completing the contract. So if the revenue is to be recognized over time, then the question arises how you will measure the progress towards completion. So that means the stage of completion we are talking here. Because in construction, people usually apply a percentage of completion method. But now that has changed, and there are we are going to see how the bases are going to be. Then how shall companies account for revenue from bundled offers? Like when you have a multiple deliverables. See, for example, if you take a mobile data plan, then there are bundled offers along with that, right? They may give a free talk time, or they may give a lot of add-ons. So should they split the contract into several components? That is what this standard is talking about. And also, how shall companies are dealing with the contract modifications, and how companies are treating the contract cost? Like how you are, in my company, we have, when this standard was introduced, we in fact exploited the usage of this standard to to support capitalizing an asset. See what has happened. We mobilized a contract in 2018, and unfortunately we could not deliver the requirements as per the contract, so the mobilization got delayed. So this standard was permitting that whatever cost you have incurred till the time of 100% mobilization of the contract can be considered as a cost to complete the mobilization, and which can be capitalized and amortized over a period of time. So that is what we are talking about here. And are there any financing components? Financing components here, what they are talking is, suppose if the receivables are yet to be collected, then you have to adjust it for the time value of money. We are all knowing, right, what is the time value of money. It is based on the cost of capital or weighted average cost of capital, what we are talking. And what disclosures do companies need to make, and do they have all appropriate and relevant information. So about the disclosure, I will share with you Bharti Airtel how they are disclosing the accounting policy as well as the revenue recognition criteria. So the 5-step model which I have, this IFRS 15 is talking about is, first one is the identifying the contract with the customer, then identifying this separate performance obligations in the contract. So first you need to have a contract, and then you need to identify what are all the performance obligations in that contract, and then there should be a transaction price, and then how you are allocating the transaction price to the separate performance obligations, and then finally you are recognizing revenue. So if you see IAS 18, what we are talking, it is only the revenue is recognized only when the risk and reward of relationship, risk and reward of the goods or services are being transferred. But here, every step involves control. First control is what? You need to have a contract with the customer. Second control is you have to identify what are all the components of that contract as a performance obligation. And the third is the transaction price. And the fourth is how you are allocating the transaction price to the different components of the performance obligation. And then you are recognizing the revenue when you are accomplishing the performance obligation. So let us see each step in the next slide. See, first one is you are identifying a contract. So contract, as we are all know that in commercial law, we talked about it as an agreement between two or more parties that creates enforceable rights and obligations. So contract means it is not a merely piece of paper. It has to be a legal document where you have enforceable rights or obligations, and it has to meet some specified criteria, and contract also can have a modification or a combination. So here the basic elements are you need to have a contract, you need to have a contract with the customer, and the contract must be approved and agreed, so committed. And then there should be a duration defined, and there is a commercial substance in the contract, and then there is a probability of collecting your payments defined in the contract. So that is the first step in identifying the contract. And if you go to the second step, identifying the performance obligations in the contract, a contract includes a promise to transfer goods or services to a customer. If those goods or services are distinct, then the promises are deemed to be a performance obligation and are to be accounted separately for its performance. And a good or service is distinct if the customer can benefit from the goods or services on its own or together with other resources that are readily available to the customer, and the entity's promise to transfer the goods to the customer is separately identifiable from other promises in the contract. So here, if you see, what do you mean by distinct? So distinct means a mobile phone that needs a provider of telecommunication services, right? Simply having a mobile device is not going to help you. So that means you need to have a data plan, or you need to have a talk time. Then only you can use the mobile, and not separately identifiable. So here what they are saying, for example, a customer is ordering a print paper, printing 10,000 copies of a book, and the paper used for the printing that book is not a distinct goods, right? Although the customer can take this paper and go elsewhere and get it printed. So similarly, construction companies do not recognize revenue when they deliver building materials to the construction site if the customer contracted them to construct the building. So that means building, construction as well as the material are cannot be differentiated. So that means it goes as one package. That is what they are saying. So if you see the next one, determine the transaction price. So the third step is the transaction price. So it is the consideration, right, in a contract which an entity entitled to in exchange for transferring the goods or services. So that means nothing is for free. So when you provide goods or services, obviously there is a consideration involved in a contract. And the consideration can be a lump sum fixed amount, or it can be variable in a form other than the cash. And it is again adjusted for time value of money. As I mentioned, sometimes your receivable may be getting struck in the contract. And so here there are impact on the variable consideration in the transaction price. So one is the variable consideration, that is what we are talking here: discount, rebate, performance bonuses, right of return, penalties, price protections, SLA. SLA is the service level agreements, and the variability may be explicit or implicit in a contract. And here, financing component, what they are saying is it should be recognized in a selling price or otherwise determined using a discount rate that would be reflected in a separate financing transactions between the entity and its customer at contract inception. So the discount rate, what they are talking here is a incremental borrowing rate. Suppose you are going for a construction contract, and if you go for a loan from a bank, what would be the rate of interest they are charging? That can be deemed to be a discount rate to adjust the time value of money which is lying in the contract. Then, non-cash consideration that needs to be measured at the fair value of the assets received. And if you cannot measure reliably, then you have to take a reference to the standalone selling price of the goods or services delivered to the customer in exchange for this non-cash consideration. And also one more element which is considered here is the consideration payable to a customer. Here it is treated as a reduction in prices, the customer the selling prices. And we will see some examples relating to this variable consideration later. And step 4 is the how you are allocating the so first thing, you have identified the contract. Second, you have identified what are all the performance obligations in the contract, and then you have identified the transaction price. Now you are going to allocate the transaction price to the performance obligations in the contract. So that means here an entity typically allocates the transaction price to each performance obligation on the basis of the relative standalone selling prices of each distinct goods or services promised in the contract. So if we are unable to, if it is not observable standalone price, then there are some approaches or methods available to estimate. So first one is the adjusted market assessment approach. So the entity evaluates the markets and estimates the price that the customer in that market willing to pay. Or expected cost plus margin approach. Here it is the standalone selling price estimated based on expected cost of providing goods or services increased by or incremented by the appropriate margin. And then residual approach. It is the difference between the transaction price less the sum of the observable standalone selling prices of other goods or services which are promised in the contract, provided it meets the criteria, like the entity sells same set of goods or services to different customers for a broad range of prices, or the entity could not establish a price for that goods or services. So this is how the step 4 works. And then finally, this is the most important step in the revenue recognition. So here revenue is recognized only when the entity satisfies a performance obligation. So that means here the timing comes, right? So an entity can recognize revenue when it satisfies a performance obligation by transferring a promised goods or services. This is where I was talking about the control, because in IAS 18 they are talking about risk transfer of risk and reward. So in shipping you may see some terms, right? Free on board, cost insurance freight, like CAF. So free on board means the moment the goods are leaving your factory or warehouse, then the risk is transferred to the buyer, right? So or CAF, so that means the risk is there till the destination point. So here, that is what the control they are talking about. So the amount of revenue recognized is the amount allocated to the satisfied performance obligation. So satisfaction means what? The promised goods or services are, the work which is required to be done on the promised goods or services are completed in its entirety. That is what they are talking. So there are two aspects here. One is at a point in time or over a period of time. So point in time, what they are talking is, which is the date when a customer obtains control of a promised goods or services, or over time when the customer receives and consumes the benefits simultaneously, or it enhances the or creates an asset of the entity's performance, and it does not create alternate use to assets, or entity has enforceable right to the payment. So those are all the conditions which we will be seeing now. So if you see the diagram, there are, the timing of revenue recognition as per the step 5. So if you see in this diagram, there is you have identified the performance obligation. So is it satisfied at a point in time or over time? By default, it will be point in time. Otherwise, it is over time. See, for example, in my company, I'm working in a company which is a maintenance services organization. But we have, like, maintenance means it is a mechanical, plumbing, electrical, and there are waste collection and building cleaning and all is there. And there is one set of business we have is fire system installation and maintenance. So the fire system installation is is actually what's happening. We have a contract where the work may go on for 1 year, 2 year, or 3 year, till the time you are completing the installation and commissioning. So there we are having a challenge in applying this standard, and till date people are still struggling to apply the standard and measure the revenue as well as the cost. So here there are two things: over time or at a point in time. So over time means there are two methods: input method or output method. So based on any one of these methods, revenue is recognized when based on the progress measured. But at a point in time, you have some control criteria. Then you are recognizing the revenue when control is transferred. So you can see over period of time, if any one of the criteria met here, so the customer, so these three conditions are very important when you want to recognize a performance obligation over a period of time. The first one is the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. So that means there is an instant consumption as well as the instantly receiving as well as consuming the benefits provided by the entity's performance as they perform. So when they provide, simultaneously both the benefits are accruing to the buyer, right? And the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. And the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So the third condition is related to the receivables, right? So this is where the receivable, they treat the receivable as two different type in the balance sheet, which I will discuss later now. So here the example is, for example, a contract to transport a package from India to Bangladesh. At the reporting period, the package has been dispatched to Dhaka, and entity A should recognize for the transportation completed to date, that is from Delhi to Dhaka, as another entity would not substantially reperform the work that the entity has completed to date. So that means the transportation work has been accomplished by entity A already. So then it is not creating an alternative, right? The point number 3 they are talking. And if you see the method to measure the progress, so there are two methods, right? As I mentioned earlier, revenue is recognized based on progress towards complete satisfaction of performance obligation. and progress can be measured based on output or input. And you can use only any one of the methods. So output method is what? It is based on direct measurement of the value to the customer of the goods or services transferred to date related to the remaining goods or services promised under the contract. So that means what you have accomplished divided by what is the unaccomplished part of the contract. And the measurement method can be surveys, milestones, or time lapse, or units delivered. And it takes into account all goods and services promised in the contract. And the major advantage of this output method is it measures the value of the goods or services transferred to the customer. And practically, is it possible? So that is what another challenge, right? The standard came in 2018. So in our company, what we do, we actually follow input method because that is more easy to adopt rather than the output method. So if you see the input method, it is based on the direct labor hours or time lapse or resources consumed. And it is also possible to recognize revenue on a straight line basis if the entity's efforts or inputs are spread evenly throughout the performance period. So people, adopt a method according to their convenience, but ultimately the auditors are the judge, right? And as I mentioned in the beginning, accounting is it is an estimation, or it's a judgmental estimation. And another important concept which is under IFRS 15, what they are talking about is warranties. And as we all know that warranties are customary business practices, right, are required by the regulation in the country. And a warranty can sometimes be a distinct service that needs to be treated as a separate performance obligation. It is the case when a warranty can be purchased separately, right? When you go for example, when you go for a buying a mobile phone, what happens? The guy will tell you, the stores guy will tell you that you buy a warranty, extended warranty for this. In case of breakage or in case of any scratches, we will replace it, right? So it is more than, it provides more than just a regular assurance that the product is not defective and that it complies with the required specifications. And on the other hand, if the warranty does just that, it provides assurance that the product is not defective and it complies with the required specifications for a minimum period required by law, then it is not treated as a separate performance obligation. And it provides criteria that assist in entities deciding whether a warranty should be considered to be a distinct service in a contract. So if from seller's perspective, warranty is considered to be a distinct service. It is like a service type warranty. When you buy a car, obviously there is a warranty, right? They say up to 100,000 kilometer, your car is covered. Your engines are. They may not be very specific when they say warranty. There is a warranty, but you have to be very clear whether the car warranty is covering the engine or chassis or your major items, because which is going to be costing you a lot. So it is again dealt with, it is accounted for in accordance with IFRS 15 as a separate performance obligation. Otherwise, it is accounted for as a provision under IAS 13. And if an entity promises both an assurance type warranty and a service type warranty, but cannot reasonably account for them separately, then they can account for both the warranties together as a single performance obligation. And from buyer's perspective, a warranty is a distinct service and it is excluded from the cost of a purchased asset and it is treated as a revenue expenditure over the warranty term. And another term which I was talking about is, this IFRS 15 is treating, see, for example, you have multiple contracts and there are some work which is in progress. So that means your contract is still not mandating you to raise an invoice to the customer. So that means you have to treat that as a unbilled revenue in your balance sheet. So that is not a receivable, but that is a contractual asset. That is what they are saying. Your contract asset is recognized when a performance obligation is satisfied. Like, there is in accounting, there is a concept called matching principle, right? If you have cost incurred, then obviously you have to match that cost to the revenue. Because if you don't have a revenue and if you are showing only cost, what will happen? Your bottom line will be incorrect. So, but the payment is conditional, but not only on the passage of time. So the other conditions attached to realizing that recognized contract asset usually relate to entities' fulfillment of other obligations in the contract. See, for example, if you have you are undertaking a building construction. So, and there are different obligations, right? There is a design, and there is a you have to do some first foundation work, and then you have to raise the building, and then you have to do some plumbing work, you have to do some civil work, you have to do some electrical work. Then those are all different promises or performance obligations in the contract. So if one work involves two different things like labor and material, then if material is available, if labor is not available, what will happen? You cannot book that material cost as a cost in your book. You have to transfer that to a account called contract assets or work in progress. So that is what they are talking about here. So the contract assets basically are different from trade receivables. We will be seeing one example here, and it is a because trade receivable represent an unconditional right to receive payment, whereas contract assets are, it is a contingent upon fulfilling the promises. And the significance of the distinction between contract asset and receivable is contract asset carries not only the credit risk but other risk as well, like performance risk, because there is an unaccomplished task in the contract. So unconditional right to payment may arise both before and after a customer is billed. And on contra, when you have a contract assets, then on the contrary, in your liability, current liability, there will be a contract liability, right? When a payment for a customer is due or already received, like advance payments, then you are recognizing that as a contract liability, and then you are accounting it accordingly. So let us see what are all the industry impacts which I was talking about when IFRS 18 came in, 15 came in 2018. So I have, this I captured it from some of the big four published articles. So if you see by each step, you see aerospace and defense. Identifying contract, first of all, identifying contract itself is a high complex area. There are different legends I have put. Very high means it is red, high is yellow, and medium is green, and low is yellow, and thick yellow and light yellow here. Okay, so here if you see aerospace and defense, very high is identifying performance. So if you are unable to identify performance obligation, then it is very difficult to recognize the revenue. So almost all the categories, performance obligation is a challenge. And wherever performance obligation is a challenge, then they are also having a challenge in recognizing revenue. So obviously, when you are investing in any of these companies' shares, you need to be very careful, because whether your revenue is correct or not, maybe this year it may be correct, and next year, because it's all a balancing number, right? Ultimately, if your contract or asset is having a lot of unfulfilled obligations or promised performances, then it is going to impact as an investor. So this is all about the industry impact. And now let us see some practical examples. So a car manufacturer, so it is for the distinct goods or services which we are talking about in point number 1, right? Point number 2, step number 2. So a car manufacturer, he sells cars to a dealer, and he promises in the contract to provide for a free maintenance to a final customer, right? So to a customer of a dealer. So for 3 years after the purchase, nowadays even people are talking about free insurance, free service, roadside assistance, a lot of promises they are giving. So such a promise of free maintenance is a distinct service and constitutes a separate performance obligation for a car manufacturer. And if you look at a telecom company, they promise a smartphone, free smartphone to each customer who subscribes for a premium telecommunication services. Unlike in see, I am in UAE, so when we take internet connection, we get a package like TV is the TV subscription is free, your landline is free across the country, you can talk at free of cost. Then you are so there are a lot of add-ons they are giving in telecommunication services. So additionally, it charges a one-off connection fee. And that also here they sometimes, if they want to encourage more connections, then they buy it. So free smartphone is a distinct good and constitutes a separate performance obligation for the telecommunications company. And connection fee is not a distinct service and does not constitute a separate performance obligation, because it does not result in a transfer of goods or services, or the control is not deemed to be transferred. And a manufactured contract. So first we have seen car and then telecom. Now we are looking at the manufacturer's contract. He is having a contract with the customer for a production of say 100,000 pieces of sports equipment, and he charges 0.5 million of upfront setup cost and 100 for each manufactured piece. So the setup of manufacturing is not a distinct service and does not constitute a separate performance obligation, as it does not result in transfer of goods or services to the customer. And similarly, an entity X produces a specialized equipment, like you see some I can say there is a eye testing equipment in a medical medical clinic, then which is installed at customers' premises. Only entities X is able to install the equipment, and so that means the the people, there is a word called OEM, original equipment manufacturer. They only know the code or secret behind that equipment, so they will not give up that. So entity X charges 5 million for the equipment and 0.5 million for the installation. So the equipment and its installation are treated as a single performance obligation, because you cannot have that service done by two different people. So the customer would not be able to benefit from the equipment or installation on its own. So then coming to the variable consideration, there is like entity A is a renovation company, okay, and they provide renovation services for individual customers. Renovation is what? It is a building, some refurbishment work. So it enters into a contract with the customer for renovation of an old house, and the contract has a fixed fee of $50,000 plus the following performance bonuses. $20,000 if the work is completed less than 6 months, or $10,000 if the work is completed 6 to 8 months, and there is no performance bonus if the work is completed after 8 months. So entity has a considerable experience in similar contracts and concludes that the probabilities of achieving a performance bonus are as follows. So $20,000, that is, if the work is completed within less than 6 months, then it is 50% chances of achieving the bonus, and 10,000 there is a probability of achieving 30%, and 0% probability if they don't 20% probability if there is chances of not achieving the targeted time. So they are adopting a expected value approach. Expected value is something which is there in statistics, right? So just you are calculating the your payout into the probability. So payout is 20,000 into 50%, 10,000 into 30%, and $0 into 20%. So which is giving a 13,000, right, as a performance bonus. So it will be included as a variable consideration when you are estimating a price. So what would be the transaction price here? So it will be like 50,000 is the value, right, fixed fee, plus there is a performance bonus of 13,000 based on the probability of accomplishing the task. So if the entity completes the work in 6 to 8 months, the revenue reversal amount only to 3,000. That is 5% of total transaction price. Next is the we talked about contract assets. So in practically how it is being done. See, you look at a telecommunication company which entered into a contract with a customer who purchases a smartphone, and there is a 24 months voice plan, and the customer must pay $100 for the smartphone in 30 days and $30 per month for the voice plan during the next 24 months. And this is how all over the world the plan works. Therefore, total transaction price in the contract amounts to 820, right? 100 plus 24 into 30. So the telecommunication company considers the smartphone and voice plan to be separate performance obligation. And 340 is allocated to the smartphone, and the remaining 480 is allocated to the voice plan. So when the contract is signed and the smartphone is provided to the customer, the telecommunication company records the following entries. So I hope we are understanding this example, right? The total transaction price is 820. So 340 is allocated to the smartphone, and the remaining is going into the voice plan. So trade receivable is what? They will recognize contract asset as 240. When the smartphone is provided to the telecommunication company, records the following entries. So trade receivable is recorded as 100 and 240 is recorded as a contract asset. Then they recognize the revenue. Okay. And as we can see, 340 of revenue is recognized when the smartphone is provided to the customer. This is the transaction price allocated to the performance obligation, which does not need to be the same as the price stated in the contract. However, only 100 is unconditionally due because it is to be paid within 30 days, and the remaining 240 is conditional on the voice plan provided by the company in the future. So that means this obligation is interdependent, right? The customer won't have to pay if the company stops providing telecommunication services. So how this 240 is recognized? So this 240, when the invoice for 30 for the first month of voice plan is issued, the following entries are made. Trade receivable is 30 and contract asset is reversed out, and revenue, the voice plan 20 is recognized. And contract liability, the entity A enters into a contract. So I hope all of you have understood the contract assets. So now contract liability, you see there is a contract with the customer to manufacture and deliver 100 products for a total consideration of 1 million. And the contract states that the customer will be billed in advance for 30% of the contract value, and the payment must be made within 30 days of signing the contract. So when you are receiving it, then it becomes a advance, right? So the advance, what you do, you will be recognizing trade receivable 0.3 million and contract liability 0.3 million. And the invoice for 30% of the contract value is issued to the customer. So the customer pays the invoice. So when the customer is paying the invoice, then you will be debiting cash and then reversing out the trade receivable. And the contract, when the products are delivered to the customer and the invoice is issued for the remaining amount, then what will happen? You will reverse out the contract liability and you will recognize the trade receivable to the extent of the balance amount, and the full revenue is recognized now. And Bala, do I have more time or can I close the discussion?
Sir, the session is for 1 hour session.
Yeah.
But you can take your own time, I think so.
No, 2 more examples are there. It is going to take another
no
10
problem at all, sir. No problem at all, sir. You can take your own time.
And any feedback? Am I going fast or should I slow down my discussion?
No, sir. It is a new information to our students. It is valuable. You go
Okay.
ahead.
Yeah. Okay. Thank you. So telecom companies, so this is also, you know, one of the industry which is impacted, right? Is a typical for dealing with huge number of clients.
Ganesh,
Yes.
check your
Yes.
one time, no problem.
Yeah, okay.
Okay,
It's
thank
a typified contract, and it has a multiple offering, right? You are signing up for an annual plan, and then you are getting handset for free. So the main challenge will be to split bundled offers into individual performance obligations and allocate the transaction price. So here, revenue for the individual performance obligations must be recognized over time, right? Because it is over a period of 2 years subscription plan, or at the point of time, like when you are when the handset is delivered. So it's a very good example to understand what is over the timing of revenue recognition, the step 5. So under IAS 18, many telecom operators provided free handsets to customers and treated them as marketing costs or cost to obtain a client. I remember when I was in India, Reliance used to provide a free handset. So what they used to treat in their books as it is a marketing cost or it is a cost to obtain a client. And in IFRS 15, such type of things are not permitted. So that means you have to allocate a transaction price to the individual performance obligation. So here there are two performance obligations. One is you are signing up the annual plan and then you are getting a handset for free. So in this case, the telecom operators have to allocate total contract price between the revenue from sale of handsets and sale of monthly plan. So as a result, what is happening? The timing of revenue changes, revenue recognition changes, because the revenue is recognized. So that is the very good part of IFRS 15. So it brings forward the revenue. So it brings forward the revenue, and thereby the cash flow is increasing, right? Whereas the IFRS 16, like lease, which I was talking about in brief, it is the working other way around. What is happening? It is bringing forward your expenditure, like your amortization, lease amortization. It comes early, and then as the year progresses, the benefit comes to the organization. But here in IFRS 15, the benefit is accruing to the organization much earlier, much in advance than what it used to be under IAS 18. So next is the manufacturing companies. So here what you have to look out for, one is, should you recognize revenue over time or at the point of time? And if it is over time, then how you are monitoring, measuring the progress, like whether you are going to use the input method or output method, and how you are accounting for contract modifications for delivering additional items of goods. Contract modifications, right? If you are entering into a contract, it can go into multiple iterations of amendment. So that is what they are talking about here. Then do you provide post delivery rebates or volume discounts or year-end bonuses to customers based on total volumes ordered during the year? Then you are probably affected by IFRS 15. Here, I remember when I was working in Unilever, they used to buy one of the chemical from Hazira plant of Reliance, and they give annual what you call quantum offtake discount. So such type of things, because this is a post delivery rebate, the quantum offtake discount what they are giving is a post delivery rebate. So that is obviously, if it continues now, it would have been impacted by IFRS 15. So should you split your contract into a more performance obligation? And this could be the case when you provide some warranty periods for your products. Should the warranty be accounted? So that is what we have seen, right? Whether it will be a distinct performance obligation, or are you providing any other services for your products? And do you incur certain costs for obtaining the contract, like bonuses to the sales team, or maybe you should capitalize them or not expense them immediately as before? So let's see an example of manufacturing company. Ball PC, computer manufacturer, okay, enters into a contract with Stanford University to deliver 300 computers for total price of 600,000. Okay, CU means it is a currency unit. You can deem it as a Indian rupees, or you can deem it as a dollar. Due to necessary preparation works, Stanford University agrees to deliver computers in 3 separate deliveries during the forthcoming 3 months. And Stanford University takes control over the computers at delivery. After the first delivery is made, Stanford University and Ball PC amend the contract, and Ball PC will supply 200 additional computers. So that means in addition to 300, they are asking another 200. So in total 500. So how should Ball PC account for the revenue from this contract for the year ended 31st December 2001? So there are two scenarios, right? The price for additional 200 computers was agreed at 388,000, being what? 1,940 per computer, right? So Ball PC provided a volume discount of 3% for additional delivery, which reflects the normal value discounts provided in similar contracts with other customers. So originally the price was 2,000. Now it is 1,940. So that means there is a 3% volume discount he has given. And scenario 2, the price for additional 200 computers now was agreed at 280,000, being 1,400 per computer. So they gave a discount of 30% for additional delivery because it hopes for the future cooperation with Stanford University. And as of December 2001, Ball PC delivered 400 computers, 300 as agreed initially and 100 under the contract amendment. So this is about, so here what is happening when you have additional, additional business, then the performance obligation changes. That is what you should understand. And the last bit is the real estate. Sorry, one more is there. So in the real estate, if you see, are typical for their contracts with customers of a long-term nature, right? The biggest challenge is whether so here the timing of revenue recognition is very important, whether you are spreading during individual years of construction or at the point of time, like one time at the time of completion of a contract. So here let us see an example. RE is a company which constructs and he is a property developer, builds a residential complex consisting of 50 apartments. And apartments are similar in size and proportions. However, they are customized according to the client needs. So what they are doing, they are entering into a contract with two different clients, A and B. Both clients wants to buy almost identical apartments and agree with a total price of $100,000 per apartment. And the payment schedule is, when they sign the contract, they pay a deposit of $10,000. And milestone 1, year prior planned completion, the RE will construct will deliver progress reports to clients, and clients need to pay 50,000 each. So based on the progress completion, they are paying 50,000. Then completion, upon completion of the construction, the legal ownership is transferred to the apartment is transferred to the clients, and they pay the remaining amount of 40,000. So that means there are 3 obligations here, right? One is you are signing a contract, so there is a advance payment, and then when you are submitting a progress report, then you are getting a payment of 50,000, and then the final stage is you are paying an amount of 40,000. Assume the period of construction is 2 years from the date of contract, and RE Construct has the right to retain payments from any client in the situation when the client defaults on the contract before its completion. So the contracts with client A and B are not identical. So further contractual terms specify that no other specific terms in the contract with client A, and the contract with the client B specifies that RE Construct cannot transfer or direct the apartment to another client, and in return, the client B cannot terminate the contract. So that means they don't have any assignment option. So they cannot assign this work to somebody else if they are not able to do the job. So if the client B defaults on the contract before its completion, in other words, does not make payments in line with the schedule, RE Construct has the right for all contractual price, and if RE Construct decides to complete the contract. So here, I can give you an example. We were constructing a labor camp, and we engaged a contractor. The contractor failed to fulfill the promises which are to be delivered in the contract. So what has happened? He had a cash flow concern, so he could not continue the contract. So then what has happened? We engaged another contractor, and we recovered the cost whatever we have incurred. Maybe it could be even more than the value of the contract what he has entered to us with us, but by virtue of legal court intervention, we could recover from him, but there is a performance guarantee he has given. So here in this case, now what is the difference here? In case of client A, the revenue would be recognized at the point of time, and revenue from B over time, right? And why? Because here we have to recognize, assess three criteria. We will not deal with the first two. So if you see this one, revenue with contract A, client A at the point of time, the contract with client A does not meet the third criteria. The reason is that RE Construct builds an apartment that can be easily sold or transferred to another client in case of default. So that means there is an alternative use, right? In this case, though he has an enforceable right to claim. Even when this would be prevented by specifically written in the contract, RE Construct has no enforceable right to payment for performance completed to date. And he will only keep the progress payments in case of client's default, and they may not cover entities cost for work completed to date. So as a result, RE Construct would recognize revenue at the point of time, that is when the apartment is transferred to the client A upon the completion of the year 2. And revenue from contract with client B over time. The contract with client B meets the third criterion. See, he cannot direct the constructed asset for the alternative use because the contract with client B does not permit transfer of the apartment to another client. So that is specifically mentioned in the contract. So that means they have the developer has an enforceable right to payment for performance completed to date. So therefore, in this case, the revenue is recognized over a period of time. And again, it is based on the input or output method. So that's it. So if you see the how the revenue recognition happens, in case of A, you are recognizing revenue in the year 2, 100,000, whereas in case of B, there is a 45% completion and 55% completion. So based on that, you are recognizing 45,000 and 55,000. And the technology and software, if you see, selling software licenses and providing various services is famous for the diversity of its operations and long-term contracts. So what are all the challenges here? One is performance obligation, identifying the performance obligation, which you have seen in the impact matrix, right? Almost in every area, it is a very high risk identifying the performance obligations. So sale of license, customization, post-delivery support, and allocating transaction price to them. And then assessment of progress towards meeting the contract, and then assessment of the licenses for the product sold by software vendors or developers. So IFRS 15 recognizes two types of licenses: license to use and license to access. Now, accounting treatment is different for both of them, and you should be able to identify which license is in question. I can give you an example. We were trying for SAP implementation. So there were, it is a cloud version, and there were two type of like what they have mentioned here. This cloud based SAP is going to interact with our, other legal or medical systems. So there is what they said. There is a general terms and condition in the initial contract, and they have given a broad license to use for the module. And later they said there is an indirect access licensing. Yeah, and the indirect access licensing, the cost of indirect license access is very, very high as compared to our cloud-based license to use cost. So then we were wondering what to do if we are, if we are going ahead, then it will be a huge cost for a mid-sized company like ours. So then we decided to suspend the project then and there. So if you see, there is an example. Many Bits is a software company who entered into a contract with client C on July 1st, 2001, and under this contract, they have two obligations, right? One is professional service consisting of implementation, customization, and testing of software. And client C has bought software license from the third party. And again, provide post implementation support for the 1 year after the customized software is delivered. So here there is two obligations, right? One is the professional service, another is the post implementation support. So many Bits assessed its total cost for fulfilling the contract. So cost of developing and the consultants for implementing and testing the software is 43,000, and consultants for post delivery support is 2,000, and so total estimated cost is 45,000. And as of December 2001, many Bits incurred the following costs of fulfilling the contract. So cost of developers and then consultants for development, implementation, and testing. The customized module is 13,000. So how should many Bits should recognize the revenue from this under the IAS 18 and IFRS 15? So let us see. Under IAS 18, they clearly provide professional services, and the related revenue falls under the scope of IAS 18. So that means they are recognizing revenue from similar services using the stage of completion or percentage of completion, including post delivery services. So that means they treat the software development and post delivery services as one big service for the purpose of accounting the revenue. So stage of completion, how we are calculating here? So total cost incurred was 13,000, which is 29% of the estimated cost of 49,000. So therefore, under IAS 18, many Bits revenue from this particular contract is 29% of 55,000. So the contract price is 55,000. So in that, the cost of on the stage of completion is 13,000. So which is coming to $15,000. And coming to the IFRS 15, it is very precise, right? Whether the goods or services promised under the contract are distinct, and whether they are considered separate performance obligations or not. So we need to do our own analysis, right? So the software customizing service and post delivery support meets the definition of distinct performance obligations. As a result, they need to be treated separately. So we need to look at them as a separate component and allocate total transaction price to them based on their relative standalone selling price. So you see how it is being calculated, relative standalone selling price. For example, software development and customization service, it is 55,000 divided by 110 into 100. And because they are charging us for support service, they are charging 10% of the package price, right? So for software development and customization, they are allocating a selling price of transaction price of 50,000, and for post delivery support, so they are allocating 5,000. So that means the many Bits measures the progress towards the completion of the performance obligation separately based on the inputs for fulfilling the contract. So here it is an input method they are following. And internal cost estimates show that many Bits estimated total cost for the contract is 45,000. So therefore, 43,000 for the salaries of software developer and 2,000 for the salaries of consultants providing post delivery support. So now let us measure the progress towards the completion of both individual performance obligations. So software development service, which is 30%, and post delivery services are 0% because there are no costs they are incurring. So as a result, what is the revenue they are recognizing? Here they are recognizing a revenue of 15,000, and for post delivery services, nothing. So you see in the tabular format, if you see, estimated total cost is 45,000 and incurred to date is 13,000. So progress is 30%, so which is 15,000, and post delivery is 0, so 15,000. So ultimately the revenue is recognized based on this. So that's it from my side. I hope I was able to deliver the concept very clearly. And if you have any questions, you can.
Sir, in the chat box, there is some queries asked by our professors, I think so. Kindly answer the queries, sir.
1 minute. Let me.
It is raised by our former head of the department, sir.
Which one?
Sir, Jay Balan sir.
Yes, sir.
This is, can you enlighten us why there are different
Yes,
standards?
sir.
See,
Yes, sir. Yes, sir.
yeah, now IFRS, the IFRS has become a common language. See, for example, you all heard about ISO standard, right? International Standard for Organization. There are different standards, right? Suppose if a company is certified as a ISO certified company, anyone can do export or import by sitting in any corner of the world. So the same way for this one revenue recognition, what has happened? International Accounting Standards Body as well as the American Financial Accounting Standards Board, they have formulated they have developed a standard, and then both have come to they have come to the terms that we will have to unify and come up with a convergence. So that is why of late IAS is slowly getting replaced with IFRS, and the standards are becoming one. Whether you go to US, UK, or Europe, or India, or anywhere in the world, there will be only one language they are going to talk. The big four firms are going to adopt only one language.
Excuse me, sir.
Yes.
But I am very happy. I'm having interaction with Dr. Ganesh
Yes.
for two reasons.
Yes.
One, he is the grandson of Maraimande Adigal,
Yes. Yes.
who is I'm having a high regard on him.
Yeah.
And secondly, Ganesh is a working personnel, though he is not directly in touch with the academic activities.
Right.
You have done a very excellent job today.
Yeah.
You have taken up a very hot topic, but you explained in a nice way, so that even an ordinary man can understand very clearly. I am Jay Balan, Dr. Jay Balan, former HOD of Commerce, CPA College, Bodinayakadu. In fact, I have raised the question that why there are different standards, despite the fact that the standards are there to bring uniformity. I came to understand that in US, still many companies are following GAAP, GAAP.
No.
Am I correct?
Yeah, it is still there. But if you read the IFRS update, there is a timetable they have set. Actually, India has already converged into IFRS.
Yes.
UK also has converged into IFRS, because I am seeing in their professional examinations, especially CPA and CIMA examinations in UK or US, they are mandating IFRS, and I am seeing that because I am a professional trainer, and of course during the training these concepts are to be taught. So which is quite evident. And the big four firms are very particular about IFRS.
Now, have they fixed any deadline?
Yes, there is a timetable published. If I remember, I can find out and share it.
Okay. Thank you.
And I think Mr. Sankaranarayanan has raised a point, which has the final say, Indian Accounting Standard or IFRS. See, both, now IFRS has become, the father of all. That's what I would say. So obviously, Indian Accounting Standards are deriving its basis from IFRS. No, may I understand the role of interpretation committee is to resolve the dispute between the supplier of goods and services and the buyer of. No, which interpretation committee you are talking about? See, standard interpretation committee is a part of the FAS, like Financial Accounting Standards Board. So there is a committee they form whenever an standard has been is being developed or evolved. There is a committee formed, and that committee is, in fact, they will take opinions, and then they will come up with the final version of the standard. And of course, they will take the what you call the collaborative views of every country, and every every country has its own mechanism, right? If you go to US, Securities Exchange Commission is more powerful, so that they are empowering the investors. Even small investor can show a company there. But if you see in India, suppose you are a small investor, can you go and sue a company and claim? I don't think so, because that case will take years of your life. Any other questions? Because I am able to. One more, Dr. N. Sarada. How about the penalties levied in the performance of a contract? Dr. N. Sarada. So see, penalties are part of the variable consideration. So it is going to impact your transaction price. And new disclosure requirements, to the best of my knowledge, I am not aware. If I come to know, I will definitely share it. For your information, during this pandemic time, I think one of the someone has asked Dr. Gnana Desigan. See, during the pandemic time, still the auditing firms are trying to protect them, their the profession. So what they are doing, there is a questionnaire. When we were completing the audit for last year, we got a questionnaire. Have you sufficiently covered your receivables which are under impairment? I mean, because during pandemic, obviously many businesses are affected and their cash flow is tremendously impacted. So in this contract asset, which is falling under IFRS 15, they are saying you have to impair. How we have to impair? Impair means you have to identify what is the probability of not getting that revenue recognized in your books. So that means obviously you have to consider the pandemic impact. That's what they are saying. You have to consider the pandemic impact. So any other questions? That's what I hope. Whatever questions posted here, I was able to answer. Hello.
So I request Dr. S. Sujata ma'am to deliver vote of thanks.
Respected Principal, distinguished Vice Principal, and Honorable Chief Guest of this, a grateful moment. A fine good afternoon to one and all present here. In the hectic pandemic period, the Commerce Department marching towards the excellence by organizing a series of webinar programs. I wish to thank the magnanimous management who is encouraging this kind of association activity, which will developing the mission is always showing a path to move towards success. And I wish to thank the head of the department who make the event successful by his innovative thinking and implementation. It gives me a great privilege to thank the resource person, Mr. Ganesh. In this nice occasion, I feel very proud to inform that is, he is our prominent scholar of our department, and he has given very valuable information regarding IFRS 15, the revision in the standard such as revenue, construction, and customer loyalty program, transfer of asset from customer and its impact, the time value of money, and clearly picturize the revenue recognition model with a practical example. Thank you, sir. Very highly scholared information, sir. It is very useful to all of us. And it gives me a great privilege to thank our former head of the department, Dr. Jayabalan, sir. And I wish to thank the coordinator, Dr. Ms. Tangadurai, as well as Madan Kumar. And I feel happy to thank all the faculty members and dear students. Thank you, one and all.
And I hope to come up with many more interesting topics as a webinar.
Sure, sir. Sure,
Okay.
sir. Sure, sir. Sure,
I am
sir.
in touch with Balamurugan, and I will come back with many more topics.
Ganesh,
Yes, Bala.
thank you. Thank you very much. A nice presentation.
Yeah, yeah.
நல்லா இருந்துச்சுப்பா. ஃபீட்பேக்கும் நல்லா கொடுத்துருக்காங்க. I will send everything in your mail ID.
Okay.
Thank you.